I am starting the live stream for those who are not joining from our Zoom call. Welcome, Afia. Okay. I've sent a message to let people know that we are beginning, so we'll wait and see. Okay, there we go. We will just give everyone a few more minutes to join before we begin. Thank you to those who've also joining us via live stream. Welcome.
How are you, Stacey?
Fine, thanks, and you, Rosemary?
Yeah, good, thanks.
Great, great. How's it going that side in Australia?
Yep, still dark. Sun's coming up soon. That's all good, all good. Thank you.
Thank you for joining us. Welcome, Cassie. I think when you're ready to begin, Ashley, you can begin. We've got people on live stream as well. So the floor is yours.
Okay, thank you so much, Stacey. Hi, everyone. Thank you for being here. My name is Ashley Spradlin, and I'm leading our workshop for today. So before I share my screen and we get started, I just want to take a second for you to do a self-assessment. So whether you're a brand new beginner newbie or kind of crypto curious, or you feel like you're a DeFi, DGen, I want you to rate yourself on a scale of 1 to 5 of like how comfortable you feel with decentralized finance. You're welcome to share it like in a chat or in the comments, or just like take a mental note. 1 being, I'm totally lost, I have no idea what DeFi is. And 5 being, I could turn a profit in no time. So just take a second to give yourself a little bit of a rating. I see some people are sharing in the chat. Okay. Awesome. Okay. So whether or not you chose to share, just keep that number in mind, and then maybe that'll help you kind of gauge your learning by the end of the webinar, and then you can ask questions as we go along. Okay, so let me go ahead and share. All right. So Yeah, like I was saying, my name is Ashley Spradlin. I'm an educational programs manager with Medis, and I also do this work with Crypto Chicks. Stacy is my partner in crime in that endeavor. So yeah, we're really excited to be able to offer this workshop for you today. So I'm assuming you know a little bit about Crypto Chicks, given the fact that you're here in this workshop. But in case you don't, Crypto Chicks is a nonprofit organization on a mission to empower women and young people in the Web3 space. So teaching blockchain education and also helping to foster startups. And our partner organization in that is actually one of the startups that came from our Crypto Chicks hatchery. It's called Medis. And Medis helps to fund a lot of our ecosystem development growth and supports Web3 apps in deploying on their network. So Medis is a layer 2 optimistic rollup. And essentially what that means is it's a blockchain layer on top of Ethereum. So the Ethereum network has incredible security and is decentralized, but traffic can get really clogged on the Ethereum network, and that can make gas prices go really high. So what Medis does is they roll up transactions and pass them through layer 1 in a bundle, which allows us to make our transactions to go much more quickly and makes them very cheap. We're talking cents on the dollar. So we have recently grown to have some of the cheapest gas fees in the space. So we're really excited about that. And so I'm going to kind of use some projects that are on the Medis network as examples as I go through the different DeFi protocols today. Just a little bit of background on Medis. We have, it's a network, so not just one DeFi focused platform. We do have a lot of DeFi projects, and that tends to kind of be the focus of so much in Web3. Everybody wants to know what crypto coins are going off and how they can turn a quick profit. But there's a lot more going on our network. We're building out Web 2 integration so that regular enterprises can move on chain. We're bringing on more oracles, NFTs. We've just launched an NFT bridge recently. We also have launch pads. We're helping to build out DAO and DAC infrastructure and looking to really expand our gaming and metaverse spheres as well. But just like our workshop today, we're going to talk about DeFi because that tends to be the topic of the Web3 conversation a lot of the times. So how did we get to DeFi? DeFi stands for Decentralized Finance. And it's a term that I think people have associated with just trading coins and getting a lot of cash. But I think it's helpful to understand how we got to decentralized finance to understand why it's important, and to compare it to previous systems of more traditional finance, or sometimes you'll hear it referred to as TradeFi or TradFi. But basically, let's talk about what our current system in the US is like. So in the US, the flow of currency, that's the word I was looking for. The flow of currency is controlled by an organization called the Fed, the Federal Reserve. And essentially, they are in charge of printing money and circulating currency, which has led to inflation. And we've kind of evolved into this system after, we started with like a bartering system and then trading like actual gold coins. And then we transitioned into like paper notes that represented coins. And we kind of moved into fiat currency, which is like the US dollar. And this circulation is all controlled by the Fed, this one organization that governs the banking in the United States. In other countries, it's called something else, but you have these central organizations that both act as a single point of failure and a single point of control for financial exchange, essentially, in an economy. And that presents some problems for a few reasons. One is that information is easily hacked. So the Fed, for example, within my lifetime alone, and I'm 33, has been hacked over 50 times, and the data has been compromised. They also have like just a small group of people making decisions. And unfortunately, that means that there's a lot of room for things to be insecure or swayed out of the interest of the majority. And so what DeFi does is it both brings some transparency to the current financial system by putting everything on a blockchain so that people can see transactions publicly. They're not eligible to be changed, and there are no gatekeepers to that information. So essentially, smart contracts in DeFi govern the mechanisms that people would have say over in a traditional banking system. And the power of that, beyond the transparency and the autonomy of just having the smart contract rather than a few people making these choices, is the decentralization piece. Now, with the blockchain, instead of there being like a center point of failure, the information lives on all of the nodes in the blockchain. So to hack it would mean to hack the blockchain, which is pretty much impossible to do. So it not only adds this level of trust and transparency, but some security to our financial system. Beyond that, it removes gatekeepers. So right now, if I wanted to get a loan and I am a citizen of, let's say, Kenya, and I want to get a loan in US dollars, that might not be available to me. I might not have access to that in my country. That maybe the banks there don't have that option for me. Or honestly, like even if I wanted to use some of those financial instruments here in the United States, depending on my background, really it's the person behind the desk who's making that choice. And in DeFi, there are no people who are like gatekeeping that system. It's allowing you to interact with a smart contract, which is going to operate as it is coded to operate. And it allows you to participate in a global marketplace without anyone having to give you permission to do so. So I like to think about DeFi and traditional finance using like a restaurant analogy. So traditional finance is more like a traditional restaurant. So to participate or to take part in those services, you have to make reservations or apply. You have to wait to be seated, and usually the seat is chosen by a host. And in finance, that might mean that you have to be verified, you have to go through a background check, and a specific list of services are offered to you based on your background. You order from a set menu. So you're given a set list of choices to choose from. You choose what you want off of this list that they give you, and then you wait for that to arrive. And sometimes those transactions can take a long time, and sometimes they're very expensive. You have to pay your bill plus a tip for the service. Now, decentralized finance is a little more like a buffet. So this is a little more self-service. You walk in, you seat yourself wherever you'd like. You don't have to explain who you are, your background, or where you're coming from up front. You just walk in and decide you want to take part. You fill your own plate with whatever you'd like from the buffet. And when you pay for your food, you're paying for the people who prepared it and put it out for you, but it's cheaper because you're not paying for someone to take your order, prepare your food, bring it out to you, and serve you. There's no tip for service. So it's cheaper, it's faster, and most importantly, you're in control of what you get to take part in. So DeFi offers a sense of sovereignty and peer-to-peer interactions. So one thing to consider, actually, let me just go back one slide there. One thing to consider is the speed of transactions. If I have a loved one who lives in China and I want to send them money, it might take me several days to be able to wire transfer money to them. And to get a bank account in other countries, you often have to have like proof of residence to receive those funds. There's a lot of documentation involved beyond the barriers of like which currencies can I access based on my citizenship. all of those things. It also can cost a lot of money to do that. So DeFi allows for peer-to-peer transactions. It allows you to be more in control of your funds. It allows things to happen quickly and cheaply without gatekeepers. Now, let's move into how you can start playing, like how you can get into the game. Centralized exchanges. This is kind of the on-ramp for people to start in DeFi or getting their first cryptocurrencies. We'll talk about the difference between centralized and decentralized exchanges, but essentially an exchange is just a platform where people come together to trade things. So you see this in like a stock market, and in cryptocurrency, we also have these exchanges. Now, you have to start off with a centralized exchange in order to participate. You buy your first cryptocurrency on an exchange centralized exchange, because they offer fiat on and off ramp services. So you can't put your US dollars into an account to buy crypto without following some laws that I'll get to here in a moment. And then when you want to cash out, let's say you make a return on some crypto investments and you want to pull some of that out to use for whatever in your life, you have to do that through centralized exchanges, because they're going to have to connect it to your bank account in order for you to like get the cash dollars. A few centralized exchanges that are really well known are Coinbase, Kraken, and Binance. So these are a good place to start to help you just kind of get into the game from the get-go. Oh, wrong way. So centralized exchanges are great for a few reasons. Number one, they're regulated. And I know that in the crypto space, that can seem like a downside, but I like to think of regulation as more of like consumer support rather than trying to like squash business. Really, they're trying to help people understand the risk that they're taking when they make investments before they do that. So just trying to help add a layer of security for people. And part of that regulation is that they have what's known as KYC and AML laws, know your customer and anti-money laundering laws. So with centralized exchanges, you're going to have to give them proof of identification. You're going to have to let them know who you are, because they have to be able to prove who the customers who are pulling money in and out of their accounts are. They are insured and they offer customer support. So if something goes wrong or you're confused about what's happening on one of the centralized exchanges, there's usually a number you can call and somebody can help you. Usually they come with higher fees, so it's more expensive to transact on a centralized exchange. But they also keep your wallet information for you. So what that means is they call them custodial wallets, which means you get to put money in a wallet, but the private keys that keep that money safe and give you access to that money is held by the exchange themselves. So that's a good and a bad thing. A lot of people don't want the responsibility of securing their own assets. So they don't want to be responsible for making sure that their private keys are safe. In which case, this is a great option for you. However, that can be a downside, because if something goes wrong with that exchange or they are somehow hacked, like that could put your assets at risk. So it's kind of a give and take there. Not all transactions occur on a blockchain in a centralized exchange. A lot of them happen kind of like in almost like an order book type of setting. So there's not the same amount of security, transparency, and decentralization that happens in a decentralized exchange. It's similar to kind of how your banking system works. Like they facilitate the exchanges themselves, they have control over what happens, and they manage keeping your money safe. So here's an example of what it might look like to make a trade on a centralized exchange. So this is from Coinbase. And basically what happens is you just go in, you decide you want to buy a cryptocurrency, you choose from the menu, and then it gives you the cost of that specific amount. You can decide, I want to buy this much ETH, or you can decide, I want to put in this much money from my bank account to afford however much ETH that would give me. So you just put in that information, either dollar amount or cryptocurrency amount that you want to purchase. They charge you a fee and you buy it. Now it's living on the exchange in your account. Decentralized exchanges are a bit different. In a decentralized exchange, you hold your own assets. You are responsible for keeping your keys safe. This is what we call non-custodial. So you're holding on to your keys. You're either using cold storage in like the form of a ledger or a hard wallet, or you've written them down, you have a password saver, something along those lines, but your keys are your crypto. So it's your responsibility to manage them. You are also going to directly interact with smart contracts to perform transactions. So when you go to a decentralized exchange, there's not a team behind the scenes making sure that, okay, this person wants to buy at this price, this person wants to sell at this price, let's make a deal here. There's a smart contract in place, and you just tell the smart contract, I want to give this amount of this, and it automatically tells you what you can receive in return, and it makes that transaction happen. This is more secure because it is on the blockchain. So it is transparent and decentralized. It's also cheaper because, like I mentioned before, you're not paying people to facilitate all of this for you. You're interacting with the smart contract. So the transaction fees are going to be much, much lower, especially if you're using a network that has low gas fees, like the Medis Network. One of the downsides to a decentralized exchange is that you have to have crypto to use them. So you can't just decide, you know what, I don't like centralized exchanges, I'm just going to put my money on a decentralized exchange. They're also called DEX, D-E-X. And I'm going to bypass that. You can't really do that because the only way to put your fiat currency, your US dollars, into an account to buy your crypto is to go through those KYC regulated protocols. So you have to use a centralized exchange to get into the game. Once you have crypto, you can move your crypto onto a decentralized exchange and make your trades from there in an unregulated space. But you have to have crypto to start. So they're not as user-friendly for brand new people to the crypto space. You kind of have to have an understanding of how to make these buy and sell and transactions and get started in a centralized exchange before you can move into a DEX. Now, I mentioned that they're a lot cheaper, so I wanted to show you an example. So on the side here that has MetaMask, you can see I've got one Medis token, and I'm going to sell it for USDC, which is a stable coin. One USDC is equivalent relatively to like $1 US. So you can see here that one Medis on MetaMask is not a centralized exchange, but what it does is it aggregates all the information from centralized exchanges and gives you the best price that you can trade at. So you can, depending on the state or the location that you live in, you can use MetaMask to make trades. It's a wallet service. But essentially, this is the price that you would get in a centralized exchange. Now, if you go to the other side of the screen, you can see that I can take one Medis and get 84.5 USDC on a DEX called NetSwap. So this is a decentralized exchange on the Medis network. So essentially, this allows me to I get more money, I get more bang for my buck when I'm on a decentralized exchange because I'm not having to pay as many fees. Now, when you look at this smaller amount, okay, 81 to 84, it's $3, not that big of a change. But when you start to calculate this for much larger sums of money, much larger trades and investments over time, it can really add up and be quite costly. So the savings there can be really, really valuable. Now, there are several strategies when it comes to DeFi, but before we move into this, I'm going to stop sharing my screen for just 1 second so I can see people. Does anybody have a question so far? If you're live on YouTube, you can put things in the comments and we'll try and get with you. But if anybody has a question, feel free to drop it in the chat right now. Or if anything that you wanted me to review before we move into the different DeFi strategies. Seems quiet on set so far, which is good. Hopefully that means everybody's on the same page. Cool. Sometimes giving these workshops, there's a whole lot of information coming at you at once. So I just want to be sure that I'm giving it in digestible pieces. So I'll go ahead and share again so we can move on. But if you have any questions, please put them in there. Let us know. All right. So DeFi strategies. The first option that you have in DeFi is to hold, or if you're familiar with the crypto community, sometimes they say hodl. It's the same thing. Hold, you buy and you keep. You use this strategy if you feel like the value of your asset is going to go up. You can consider it in crypto or even in the stock market. We have these terms bearish and bullish. Bearish means, or bear market means that overall sentiment is pretty low and negative. You kind of feel like things are on a downturn. Bullish means you're optimistic that the value is going to go up. So if you're bullish on an asset, you think that the value is going to increase. Your strategy is to buy and hold that asset because one day it will be worth much more than it is right now. So this is more a focused strategy for long-term gains. And one tip that I want to be sure that I clarify is that when you buy cryptocurrency on an exchange, whether it's a decentralized exchange or a centralized exchange, I highly encourage you to keep that crypto in your wallet after you purchase it. Don't just leave it sitting on an exchange because then it is, it's more easily compromised. While the transactions that occur on the blockchain are extremely secure, the web apps that you use to interact for these transactions, there can be vulnerabilities in their smart contracts. We're going to talk a little bit more about that toward the end of presentation today. But in order to keep your crypto as safe as possible, don't leave it sitting on an exchange unless you're about to make a transaction. Keep your money in a wallet. All right, so the next strategy would be to trade. So you buy and you sell for a profit. You can use DEXs for buying, selling, and trading on Metis. We've got NetSwap, Standard Protocol, and Medis Finance, just to name a few of them. But essentially, this is where you're looking for a dip in price of an asset. You want to buy when you think it's low, and then you want to sell when you think it's high. And so this is a risky strategy for people who are looking for short-term gains. You see a lot of information about people who are trading online and they're making a whole lot of money, but really people don't share their failed stories near as much as they want to share their successes. So for every person who's made a giant bag trading in crypto, there are about 10 other people who have been wrecked or rinsed, or in other words, have lost their money. So I think it's really important that if you're going to trade, you really understand the technical utility behind a project and why you think the value is going to go up. You need to understand the mechanisms that you're working with and the intricacies of each project. Otherwise, it's really easy to buy high and then be forced to kind of sell low. There's a lot of emotion involved in trading. So I think it's important that you have like a goal in mind, like when do I want to pull out money before you get started here. There's a lot that can be said on trading. Generally, I think if you're brand new to DeFi, this is probably something that you wait a little while to get involved in, unless you really just have money that you can afford to play with. So here's an example of making a trade on a couple of the exchanges that are on the Medis Network. And just like I mentioned to you, the the costs of trading on the Medis network are much cheaper than on, let's say, Ethereum. But I wanted to show you the difference in a couple of these. So I took these screenshots maybe about 2 minutes apart. So the Teddy's one I took first, and you can see I was going to trade 1 ETH for 36.35 Metis. So that was my exchange there. There's a few things to notice. First thing is, a couple minutes later, the value of my trade went down just slightly. So the value of the tokens that you're trading in can change. And from the time that you decide, okay, I'm going to trade my ETH for my Metis, and then I click connect my wallet and make this transaction happen, from that time, the price that I'm quoted might change based on the market value. So what I actually receive after the transaction is complete might be different than the price that I was quoted when I agreed to make the transaction. This is called slippage. So if you notice, it's got slippage tolerance here. The same thing we're here where it says price impact, that could be representative. So basically, the amount of change that I'm allowing from the time that I click that transaction okay to when it actually goes through is slippage. So in this one, I'm saying I'm okay if there's 0.5% change in my trade in order to make it happen. But you can set that limit. You can say if anything more than 0.5% of slippage occurs in the time it takes for this transaction to be complete, then I want to cancel it. So that you're not losing out on more than you agreed to in the first place. Now, one of the things that's really powerful about the Medis network is the speed of transactions. So because things happen so quickly, your slippage is a little bit less of a risk. So in transactions where the network is running a little more slowly, your risk for slippage exposure could be a little bit higher because there's more lag time between the time you approve the transaction to the time it actually occurs. Yeah, so I think that's good for now. Let's move on to the next one.
We have a hand up. I don't know if you can take
I can't see. Yeah, let me stop sharing. Okay. Hi, go ahead and share your question.
Hi, thank you so much. I'm really enjoying this.
Cool.
I do have a question. You're probably aware both Binance and Gate.io has told Ontario consumers, you have to clear or we're taking your money. Now I have my funds on mainnet. It's on mainnet with Polygon, mainnet with Harmony. However, I've linked my MetaMask wallet to both. So am I technically in a wallet or am I still on mainnet?
So are you keeping it? Are your funds in an exchange, like on an exchange platform?
I moved them off of Binance and off of Gate.io.
So they're just in your wallet then?
Onto the network. It's on the network. That's where I transferred it to. But in my MetaMask, I do have Polygon and I can see my balance, and I do have Harmony One and I can see my balance.
Yeah, I think that you're good. When you took those off of like the Binance exchanges, you put them in your wallet, you're connected to those other networks, but your funds are living in your wallet right now.
I thought they were living on mainnet because I didn't well, maybe. I'm not sure.
So you're connecting your wallet when you like do a drop down and see like, okay, I'm on Polygon mainnet or whatever, you're connecting the funds in your wallet to interact with dApps on that network. So
and I can see my balance.
Your funds into that necessarily.
I see my balance on MetaMask under Polygon.
Yeah, so you can hold funds on that network in your wallet, if that makes sense.
I can view it. I can view it.
So like right now, I can look at my MetaMask and I can see that I have funds on the Ethereum network and funds on the Medis network. Now they're in my wallet, it's just they're connected to those specific networks. So you can either bridge your funds from, let's say, Polygon to Ethereum and back and forth, but they're not living on an exchange. So
they're on mainnet.
Right. They're connected to those networks.
But connected to my wallet because I can view it.
Yes.
Is it safe?
Yeah. Yeah. As long as you're like being smart with your private keys for your wallet, then yes. I would just say, like, let's say you were going to make an exchange using the Binance exchange platform. You wouldn't want to leave your coins in your Binance account after you did your exchange. You'd want to
pull. Binance kicked me out. Binance said, if you do not move, we're keeping your money. Basically, that was the message.
Regulation has been really wild. Depending on like what part of the world you're in, you may or may not be able to use certain platforms. So yeah, staying abreast of that is quite important. But yes, as long as your funds are in your wallet, it's okay if they're connected to the network. As long as they're not living in an exchange account, you should be good.
Okay. Thank you.
Yeah, absolutely. Thanks for asking. Thank you, Stacy, for letting me know. When I'm sharing my screen, I can't see anybody else. So if you have any other questions, please do give me a shout. Okay. Let's see. Let's go back to sharing our screen here. Okay. So we talked about holding, we talked about trading. Now let's talk about staking. So staking is essentially when you provide funds to help secure a network. So there are a few different mechanisms, what we call consensus mechanisms, that secure a blockchain. So if you'll remember, if you've taken the blockchain 101 course, when transactions are added to a blockchain, everyone who operates a node on this blockchain is agreeing to the accuracy of that transaction. Okay, this consensus mechanism is what secures what we put in. Otherwise, somebody could just put whatever transaction they wanted onto the blockchain, and with nobody there to check it or validate it, then it could be compromised. Somebody could put whatever they wanted to in there. So having this validation consensus mechanism makes the network more secure. So this is very simplified, but I think that should give you the gist. So providing funds to help secure a network is called staking. So generally, to be a validator of a network, to say, I'm going to contribute to providing honorable consensus to the transactions that I see show up on this blockchain. You can receive rewards for doing that. But you also have to put a little skin in the game, because the network needs to know that it is in your best interest to act honorably and truthfully. Otherwise, you may have validators come in with bad intentions, and they may try to pass through fraudulent transactions on the network. So in order to incentivize verifiers or validators to act accordingly or benevolently, then they have to put up usually a large amount of money and lock it into the network for a specific period of time, so that they have some risk in the game. So that way, if they act out of interest or in some way that's like out of integrity for processing the transactions on the network, then they lose those funds. Those funds are slashed. So this is kind of like an incentive game of, I'm going to help provide consensus to approve everything that happens and to promise you that I'm going to make honorable and honest choices. I'm going to give you this amount of money to hold while I do this. And it's not going to be available to me. And if I act in a bad way, if I try to do something fraudulent, then I lose that money. So there's kind of this trick with a network to see, how much money do I have to hold for a person in order to disincentivize them to do something fraudulent on my network? And this can be really expensive for some people to be able, like, I might want to contribute my money to receive rewards from a network, but maybe I don't have like 32 ETH, which is somewhere in the ballpark of like $100,000. I don't have that to just offer up for you to hold and slash in case something goes wrong. So I can't really contribute in that way. So what they've done is, a lot of platforms have offered staking pools. So they'll say, we've got some validators who are working on this network, and what we can do is collectively provide the funds to stake and say, we're gonna help secure the network, and all of this money is together in a pool to stake. And that allows some flexibility. So if funds can either be locked in for a long period of time. So for example, right now, if you want to stake ETH2, that money is locked and untouchable to you until if and when that merge happens. So if it never occurs, you never get that money back. When it does happen, then you may receive token rewards in exchange for providing those funds to help secure the network. So there are some options for making money on this. You just have to be very clear on what are my withdrawal options, how long are my funds locked, and what's the likelihood that someone who is using my funds as proof of stake to validate this network might act outside of the best interest of the majority. So some places that you can look to stake on Medis. We've got a few examples here: Binary, Tethys, Hermes. All of these offer staking options, but you can stake depending on really the type of network or the project that you want to help to support. So I can stake tokens on the Tethys finance model for several different things. I think I've got actually a screen share next. Let me just show you instead of talking you through it. There we go. Okay, so I can decide to stake Tethys. I can stake other options on the Medis network. I can stake other coins, and it will offer me an APR. So this is like my percentage rewards. It might tell me how long I can stake it at. Now the risk here is these rewards that you receive for staking are going to be in the tokens. So if I stake, let's say I spend $500 to buy Tethys tokens, and then I stake that money and I can't sell it. It's staked and it's locked for a certain amount of time. Well, now the value of Tethys is going way down. I don't have the option of selling before the bottom drops out. I've got to stay and hold it there. So even though I might be earning those rewards, if the value of that has gone way down, then it doesn't necessarily bring me a return on my investment, and I've got to hold that until the value comes back up, if that ever happens. So that's the risk with staking is, can I trust the people who are validating the network and I'm providing my funds to the staking pool? And beyond that, how long do I have to keep my funds in this pool before I'm able to withdraw them or use them in another way? And do I trust that the value of this token is going to remain pretty steady or go up during that time that I'm not allowed to make any trades or do anything with it? Next up will be farming. Now, farming is a little riskier. So I think if I were going to kind of order these in rank of risk, I would say holding is the least risky, as long as you've got it in your wallet. And then I would say probably staking. And then we'll go farming and trading, depending on your methods. So farming is going to be when you provide liquidity for exchanges and transactions on a platform. So basically, in a stock market, when people want to buy and sell stocks, they put in orders. So they say, I want to buy this stock at $50. And so that gets recorded in an order book. And they wait until someone who has that stock says, I'm willing to sell it for $50. Once that happens, they make that connection and the trade occurs. You have to wait for there to be a buyer and seller present. Now with liquidity pools, which is something that's used in a DeFi platform, you have all of these funds in a pool already. And so you're providing liquidity so that the smart contract can make these exchanges occur instantly without having to say, oh, I've got a buyer for this, I need a seller for that, and back and forth. So it's already there, it's held in the smart contract. So that people can do their exchanges and transactions using the liquidity that's in the pool that is already held. Liquidity is a fancy word for money. It's the cash money, the actual tokens that are in the pool held in reserve so that people can do whatever they need to do on the network. You can receive rewards for putting your funds into a liquidity pool on a network. And sometimes those rewards can be really attractive. So we're going to talk about what that means here in a moment. On the Medis Network, you can do farming with Beefy Finance, Teddy's, Hermes. Beefy Finance is a great one because they do what's called yield optimization. So they can show you different pools on different platforms with different tokens. They rate it based on risk, and you can see how much you can earn. So let's look at, I think I have a screenshot of Beefy. Yeah. So this is the interface of the yield optimizer dashboard on Beefy Finance's website. So I would love to do like a walkthrough of all of these with you, like live time, but I just don't think we would have time for all of that. So I'll make sure that any of the links to these projects are available to you, and hopefully the screenshots will be helpful. But essentially, if you look here, you can see that I've got a liquidity pool of DAI and Medis. Now, DAI is a stable coin. So essentially, these liquidity pools mean I'm going to put 50-50 of each coin into this pot. Okay, 50% DAI, 50% Medis, they go in. Now, the idea is that we want to keep the ratio as close to 50% as possible. So if the value of one of these skyrockets, then it's going to make my exchanges less optimal. Less optimal is the word I was looking for. So for example, let's say I want to provide some Medis to this pool, and my APY here says 58%. So I could earn 58% annual percentage yield on providing my liquidity to this pool. Now, my yield, though, is going to be in Medis tokens. So if you think, okay, well, the value of those tokens by the time I'm able to like pull that money out is going to be really high, then maybe that's a wise investment. If you think the value of those tokens are going to be lower, then you might be locking in your money or farming your money into this pool and then not be able to pull out exactly what you pulled in. This is called a permanent loss. And I think going into like the specific mechanisms of all that is a little more than we have time for today. But essentially, what you need to be aware of is you want to know that if the value of one of these tokens is going to skyrocket, that's going to upset the equilibrium of that ratio in your liquidity pool. Similarly, if one of them drops, it's the same concept. So you could potentially lose some of the token value of what you put in on those rewards. Also, if the token value goes up or goes down, then the rewards that you receive are going to be in that token. So they may be worth a whole lot more or not very much. But what I love about the Beefy Finance platform is that they make it pretty straightforward for you to see what you're depositing, what your yield will be, what you get on a daily basis. So if you have a flexible withdrawal option where you don't have to lock it in for 6 months, maybe you could just stake it for however long you want. You can see what you might earn on the daily. And then they give you a safety score, and they give you opportunities to learn more about the specific pools that you're investing in. All right, I think this is our last one. This is borrowing and lending. And luckily, most of us are pretty familiar with borrowing and lending in a traditional sense. With DeFi, it's the same as it works in a traditional loan situation. It's just peer-to-peer now instead of going through a bank. So in DeFi borrowing and lending, you don't have to go to a bank and fill out a loan application and all that. So you can just say, I have 500 ETH that I'm willing to lend for interest to someone else. Someone else says, I really need to borrow 500 ETH. So they're going to put up collateral, and different platforms offer different options for collateral. And essentially that collateral is held through the lifetime of their loan, and they don't have access to it. They technically still own it, but they can't do anything with it until they pay back their loan plus interest. So the borrower puts up their collateral, they borrow the money from the lender, whatever cryptocurrency they have, they pay interest on that. The lender has put their money up, and they receive that money back plus interest as the life of the loan goes on. So it's quite similar to a traditional borrowing and lending setup. It's just now it's peer-to-peer. So people are doing it with one another. And Agora on the Medis Network offers borrowing and lending. So I'll show you their platform here. You could choose to do stable coins or ETH or other altcoins. It's up to you. They show you the different percentages that you can get in return for offering, so lending or supplying. And then if you're borrowing, then it'll show you the rates that you would pay for interest. Now, the thing to remember is that your interest is going to could be in tokens. So like if you're paying, let's say you've borrowed, several $100s worth of one token and you're paying interest on that, but then the value of it goes down dramatically. Like you may now be in debt for way more than you like put in to begin with. So it's really important that you have an understanding of what the value of that token is doing, and you keep an eye on that in your borrowing and lending. Okay, so let's talk about risks. Before we move into that, I'm just going to do a quick pause, quick check and see for questions. I've got a couple here in the chat. So geography aside, is there a recommended way to determine best wallets and exchanges when presented with multiple choices? For my preference, I prefer wallets that have a lot of interoperability that you can use on a lot of different networks. That's why I like MetaMask, because I can use it on a lot of different networks and connect it to different chains pretty easily. And depending on where you live, you can do transactions within your MetaMask. You can do swaps and whatnot. But to determine the best, I would just say, like, what kinds of transactions, what networks, what dApps are you looking to interact with? And are they integrated with that wallet? That's really the best way to make that choice for yourself. And I always recommend that people have a cold wallet or a hard wallet storage to back up what they do when they're connected to the internet. When we call that hot wallets, essentially anything that's connected to the internet is going to be hot. So your funds are safest when they're stored on that like little USB that looks like a ledger or something similar. That's the most secure form of storing your crypto, is in a cold wallet. Can fiat be held in any crypto wallet, or does it have to sit in a coin? I ask because of the tax, since everything is called a trade. And do you know of any crypto tax companies? I'm scared of exiting projects and don't know how to even plan exits. Okay. So a few things here. Number one, I'm super not a tax professional. So please seek legal advice, because it changes depending on like what part of the world you live in and all of those things. And I don't want to give you bad advice and then you be screwed by the tax man. So check with licensed professionals on this. But to my understanding, in the United States, taxable events are when you cash out and have earned a gain. So you're taxed at capital gains on those assets. As far as just holding fiat, you can't put US dollars in your wallet necessarily. But you can put them in a stable coin and hold a stable coin in your wallet. So I don't have US dollars that I can just go put in my Coinbase wallet, for example. I can use those US dollars on the exchange to buy stable coins and then keep those stable coins in my wallet. So that's one way to have your money in crypto, is to use stable coins without worrying so much about the value, just having them sit there so that you can use them for transactions or whatever you need. Crypto tax companies, off the top of my head, I don't have any recommendations. At a lot of conferences that I've been to, I've met a lot of lawyers and people who are specifically working with people who are trying to sort out their taxes when it comes to their crypto investments. So, excuse me, it is a huge need that's on the rise. And so a lot of people are coming out saying, I can help you with this. I don't have anyone that's vetted that I know, though, that I could recommend to you. I can ask our team. Otherwise, I would recommend asking for a free consultation with a few people and just seeing who you trust in that way. let's see. For Ontario, Canada residents, someone recently deposited with Newton and they really like it. So that's nice. Okay. It's a good recommendation for any Canadians. And then the dApps that I mentioned, NetSwap, Beefy, Tethys, they operate with MetaMask. Yes. So you have to, because they're on the Medis network, you connect the Medis Andromeda network to your MetaMask and you can move your funds. We have a bridge that goes from ETH to Andromeda. You can use a bridge to bring your funds over, and yeah, you can interact with any of those apps through MetaMask. Yeah, great questions. Yeah, absolutely. If anything else comes up, we got a little more time, let me know. I'm going to go through the risks real quick. I don't want to run us out here, so let me get back to presenting. Okay, so volatile interest rates and market value. So this is something that I've said in a few different ways a couple of times. So basically, a risk in DeFi is that the rates of interest, let's say you get like a staking thing advertised to you and it says you get like 1,000% APY, and you think, okay, $100 times 1,000, this is how much money I'm going to have in a year. Doesn't necessarily work that way, because the value of whatever token you're investing may change, and that could go really well for you or it could go really bad for you. And the rewards that you're getting in these yields are in that token. So if the value of that token goes way up, you're sitting pretty, but if it doesn't, then you may not be seeing the returns that you wanted. You could be losing money. When it comes to yield farming, having liquidity available in that liquidity pool can make the price impact high. So essentially, in my liquidity pool, I mentioned I might have two assets, and the goal is to keep the same amount of each one in there. If I pull out a whole lot of one asset, then the sales price of what's left in there is going to go way up, because that's the principle of supply and demand. If there's less supply in the pool, then the cost of it is going to increase. So your price impact can change. If there's way more of one asset in the liquidity pool than the other, then the price of that one asset that's a lot lower is going to go way up. So you just got to keep an eye on that ratio in your liquidity pool. It could kind of lead to a negative experience. Scams and fraud. This unfortunately happens. Now, the great thing about Web3 and DeFi is that smart contracts are controlling these transactions. I get in my wallet, I interact with a smart contract, I make a trade, or I stake, or what have you. And it's different from regular banking, because I'm not going to a bank with my hat in my hand saying, here's my background, here are my papers, here's my blood test, my urine sample, here's all these things. Please let me have access to these financial services. None of that's there. However, smart contracts can have vulnerabilities. So we're kind of trading human error for smart contract vulnerability. Because here's the thing, humans are writing these smart contracts and they can have bugs in them. And a lot of times we don't see the bugs until the money is already lost. So that does happen. There are scams out there. There are contracts written to drain liquidity pools. And unfortunately, this is kind of like the reputation of the crypto space. And I think it's important to remember that the squeaky wheel gets the most oil. So there's a lot of attention given to things like this. So we'll talk about how to look for these things and to spot red flags here on the next slide. The next piece is centralization. So some projects, if they have a single point of failure, if they're controlled by one person or a specific team, that could be a big problem for you. So for example, if I interact with a decentralized exchange that's governed by a handful, let's say 5 people, and one of those people has the authority to make changes to the smart contract, well, that person has no incentive not to just drain all the money and run, right? Like, what's keeping them from taking the assets that we've put on the network and getting out of Dodge? So when you have that centralized control where one person has the ability to edit the smart contracts, or one person has the ability to take money out of the reserve, then that puts the users at risk. Finally, there are some strategies that are unsustainable. So one of the strategies I learned about recently is where you buy an asset, then you loan the asset, you borrow against it, and then you like reinvest. It's called looping. Honestly, it's very confusing. And the point is that it's risky because you're continually leveraging what you've purchased in order to get more. And if the price of that token is like stable or going up, that's great. But as you continue to leverage your assets to get more interest, you're creating more pressure to buy. The value of that token is going to tank. So a lot of these strategies that sound really exciting and people are like, oh, it can't fail, they often do because well, let's face it, people are not rational economic actors all the time. And these mechanisms don't always work in the way that we think that they will. So if something sounds just way too good to be true, maybe you should listen to that. It might be so. So some things that I think you can look for in DeFi tips for due diligence. You should always be able to communicate with projects. So check out their Twitter, join their Discord, hop in their Telegram. If you're not sure of how something works or why something works a certain way, you should be able to ask questions and somebody should be responsive with you. And if you're not getting the answers that you need, or if you're not being treated with respect and care and kindness, and people are not taking the time to explain things to you, don't give them your money. Okay, so communicate with people. In the crypto space, it's pretty common for developers and people behind projects not to dox themselves. Dox means that your identity is available to the public. So you may not know exactly who you're talking to, but somebody should be able to come and answer your questions. You should also be able to read their documentation. And if you're not sure about what you're reading, if you're confused, ask questions. You want to be sure that projects have audits. So remember, I talked about smart contract vulnerabilities. Audits can be really helpful with that. Essentially, a team of developers goes through and they run all these tests to see what in this contract is vulnerable, where could it be exploited to take money. Stay engaged with their news. This will help you have an understanding, not fully, because anybody who says they can predict what's going to happen with the value of a token is it's not real. So nobody knows what's going to happen. So many things can impact public sentiment, the economy, the market. All of these things can change for a number of reasons, but it's very helpful to stay engaged with the news of projects that you're invested in. Know what things are coming up with them. If they're having a big problem, something has been exploited, are your funds safe? If not, what are they doing to make that change? What can you do to get your money back? Now, ideally, like, you're engaged with these people, you've done your due diligence, your funds are not exploited, but either way, this will help you keep kind of a gauge on what the token value is and how the project is working, whether or not they're doing well and growing and expanding. I think my last tip is that you stay focused on growing decade wealth. So try not to focus on instant gains. It's really easy to come into this space kind of with this moon boy mentality of, I'm going to get a Lambo and I'm going to buy this little coin and then I'm going to have all this money and it's going to be awesome. And it's not saying it can't happen for you, but I think the wiser bet is to focus on being in this for the long term. Look for projects that have strong tech utility, and invest with teams that you trust and that you see doing the good work. And trust that you're very early to this game. You're going to win some, you're going to lose some, but over time, that's what we're looking for. We're not looking for these quick flips because it's really easy to lose your back. Okay, I think, let's see. I'm interested in switching our house mortgage to a DeFi lending company. Where do I start for Ontario, Canada? Interesting. So I'm not sure if there are any legal things for mortgages in Canada. So I'm not the best person to ask about that, but I will take note of this question and I'll see if I can find any resources for you.
Probably. Thanks for answering the question.
Absolutely. So before I go into more questions, I just want to let you know that we do have a couple of podcasts that are helpful for newbies in the space. So Crypto Chicks Corner is our Crypto Chicks podcast. It's like 10-minute episodes. They're very short and digestible bits of information. And then the Weekly Wisdom is a podcast where we interview projects that are on the network or team members to talk about different things going on in Web3. So those are a little more like hour-long interview forms. Some of them are shorter, but Crypto Chicks is very short. And these are really helpful if you have a specific topic that you want to learn about. Also, I produce both of these and I'm super happy to take your recommendations. So if there's a topic you want to hear more about, if you want to learn about something, send me a message, reach out to us through our social channels, let me know, and I'll create an episode for you. And yeah, if you listen to them, please rate and review. Before we go into any more questions, I just want to give a thank you to our sponsors. Crypto Chicks is a nonprofit, so we rely on donors to make our work possible. And Women of Crypto is a Metatora project where they've created these limited NFT renditions of all the women in the world, and it's really awesome. So I'm really appreciative of their support and wanted to thank them. So that is all for sharing now. Anybody else have any questions or anything that I can touch on before we end our session for today? Cool. I'm not seeing anything. Lee, I'm going to make a note to see about DeFi lending for mortgage. And I will also see if there are any crypto tax experts that anyone on my team can recommend. Okay, cool. All right, well, if that's all, I just want to thank you so much for being here. Thank you for supporting Crypto Chicks. And I really enjoy these, so please reach out, give us any feedback. We're very open to it. Anything we can do to improve your learning experience, please let us know.